Welcome to Ahead of the Curve from K33 Research. Today is August 18th, 2026. If you want to explore the data behind today's discussion, you'll find the full report at k33.com/research. Bitcoin is still sitting around $64,000. In fact, it has been around that level for 5 consecutive editions of Ahead of the Curve. But the lack of movement is becoming interesting in its own right. Volatility is approaching some of the lowest levels we've seen this decade. Bitcoin is now less volatile than the Nasdaq, and while price barely moves, leverage is gradually building underneath. That combination rarely lasts forever. The question isn't whether this market eventually wakes up. It's how violent the move could become when it does. Let's start with just how unusual the current calm has become. Average daily spot volume fell again last week, reaching its lowest level in almost 3 years. 7-day Bitcoin volatility dropped to just over 0.5% on Sunday, the lowest reading since 2023. 30-day volatility is similarly compressed. On August 16th, it reached the 4th lowest level of the entire decade. But the comparison with other markets is even more striking. Bitcoin's 30-day volatility is currently below both gold and the Nasdaq. That has happened with the Nasdaq only 4 other times in Bitcoin's recent history. In late 2018, late 2022, early 2023, and in April last year. 3 of those 4 episodes were followed by very sharp moves. 2 were down, 1 was sharply higher, the 4th was a more moderate rally. So history doesn't tell us which direction the next move will take. But it does tell us that this degree of calm is unusual. There's a fairly intuitive reason for that. Stability encourages leverage. When Bitcoin barely moves, leveraged positions survive for longer because fewer traders are being liquidated. At the same time, low returns encourage traders looking for more action to increase their exposure. Slowly, leverage accumulates. We're seeing that now. Open interest in Bitcoin perpetual futures climbed to a new yearly high over the weekend. Interestingly, it then dropped sharply on what was only a modest move in Bitcoin, from around $63,000 to $64,000. That sensitivity is important. It suggests there's enough leverage in the system that relatively small price movements can already force meaningful changes in positioning. Funding rates, meanwhile, remain choppy rather than clearly bullish or bearish. So once again, the data doesn't give us a strong directional signal. It gives us something else. Squeeze risk. And that squeeze could happen in either direction. The options market tells a similar story from another angle. Implied volatility is close to all-time lows, which means options are pricing in remarkably little future movement. At the same time, the historical record suggests that periods like this usually end with volatility expanding sharply. That creates an interesting setup for traders who expect a large move but don't want to choose the direction. One way to express that view is through a straddle. In simple terms, you buy both a call option and a put option around the current Bitcoin price. If Bitcoin makes a sufficiently large move in either direction, the position can benefit. The trade is essentially a bet that the market is underpricing future volatility. And with option premiums reflecting some of the lowest implied volatility we've seen in years, that argument is becoming increasingly interesting. Zooming out, the fundamental market picture hasn't changed much. Existing Bitcoin holders still seem reluctant to sell at roughly 50% below the all-time high. External investors, meanwhile, remain reluctant to commit fresh capital. That's what has created this stalemate around $64,000. We continue to believe the broader setup resembles the later stages of previous Bitcoin bear markets. On-chain patterns, volumes, volatility, derivatives positioning, and sentiment all show similarities to periods of peak pessimism in earlier cycles. That doesn't rule out another move lower. But at roughly a 50% drawdown and close to Bitcoin's 4-year average price, we continue to view the long-term risk-reward as attractive. The market may stay in this range for another few weeks. The important point is that every additional week of stability gives leverage more time to build, and that can make the eventual exit from the range more aggressive. There's also a new piece of evidence this week that changes how we should think about exchange-traded fund selling earlier this year. The latest 13F filings let us separate institutional ownership from everyone else, and the result is surprisingly clear. The second quarter saw the largest quarterly Bitcoin ETF outflow on record when measured in Bitcoin, but institutional exposure was essentially unchanged from the first quarter. That means the enormous selling pressure we saw through ETFs in May and June came predominantly from holders outside the 13F reporting universe. In practical terms, that points mainly to retail. Institutions weren't the ones driving the exodus. Institutional Bitcoin ETF ownership has declined for 3 consecutive quarters, so we shouldn't pretend institutions have been aggressively accumulating. But the pace of those declines has been fairly modest, and that raises the possibility that institutional selling pressure is now approaching exhaustion. The distinction matters. A market where institutions are abandoning Bitcoin looks very different from one where retail capitulates, while institutional exposure holds relatively steady. ETF flows themselves were almost completely flat over the latest 5 trading days, with net inflows of only around 180 Bitcoin. Even that number masks a fairly weak week. Every trading day last week saw outflows, before a strong inflow on Monday pulled the 5-day total back into positive territory. So there is still little evidence of sustained external demand strong enough to break the current stalemate. There are potential catalysts ahead. The Federal Open Market Committee minutes arrive tomorrow, and geopolitical risk could return to the foreground after the 60-day diplomatic deadline between the United States and Iran passed without an agreement. But we have spent much of this summer watching catalysts come and go while Bitcoin barely reacts. At this point, the more interesting setup may be inside the market itself. So where does that leave us? Bitcoin looks almost petrified. Volumes are disappearing. Volatility is lower than the Nasdaq. Buyers aren't committing. Sellers aren't selling. But leverage is building precisely because nothing is happening. And historically, that's where the calm starts becoming unstable. We don't know whether the break comes higher or lower. We do know that the conditions for a larger move are becoming harder to ignore. Sometimes the most interesting thing a market can do is absolutely nothing, because eventually someone moves first. Thank you for listening to Ahead of the Curve from K33 Research. Subscribe for future market updates, and remember to check out the full report at k33.com/research.